Hello and welcome. This is Gordon De Silva, the MD of Gordon's Knights, and today we're going to be talking about limited companies or partnerships or something else. And one of the things that I hear a lot about, and I get a lot of questions about, especially nowadays, is dividends save tax, don't they? And that's one of the common conceptions, and it used to be a conception, but it's now a misconception, and it's as a result of what's happened recently in the recent budget announcement, or the post-election budget announcement. It's yet to come into law, so don't take any action just yet, unless you seek proper financial advice from a qualified individual. But this is suddenly something you should be thinking about. And I had a client recently who actually formed a limited company, and his main reason for doing that, because he actually thought dividends only have 10% tax compared to income, which is 20%, 30%, 40, 50%. And it was so far from the truth that it was a bit of a shock to him. And I don't want that to be a shock to anyone else. Not many people think it's 10%, to be fair. They know it's lower tax than sometimes being self-employed, or certainly on PAYE, but they're not sure exactly how much less it is. And what I wanted to do today is just give you a basic background of the problems that are now involved as a result of new legislation potentially coming in. The history of it is that as a limited company, you'd pay tax on dividends at 20%. And if you were a sole trader or a partnership, you would not only pay tax at the normal rate, to say 20%, but you'd also pay national insurance at 9% or so. Let's call it 10% just to keep the number simple. Now, if you earned a lot of money, so just say you earned £500,000, now let's scale it down a bit. Let's make it £100,000. That's more reasonable, isn't it? If you earned £100,000, if you were a sole trader or partner, then what you would get is a tax bill based on your income, but the national insurance, the 9%, would stop at about £45,000. But the tax would be at your normal rates. The first 10,000 would be nil. The next 30-odd thousand, 34,000, would be at 20%, and the rest of it would be at 40%. And when you get to over 150,000, you get to 45% now. These rates are obviously based on when I'm recording it. In a limited company, same thing. You have the dividend. The tax is the same. It's it's 0% on the first 10,000, which is done through a salary typically. Then you have your corporation tax, which covers your basic rate tax on the next 30-odd thousand, and then you have higher rate tax of 40%, and then you have higher rate tax of 45%. So what you're basically saving is this 9, let's call it 10% off this 40-odd thousand pounds. So let's call that 4,000, let's call it £5,000 just to be super safe. And so you're saving £5,000. That's not bad, right? For not doing very much and having a limited company, if you can save £5,000, if the cost of running a limited company is less than £5,000 more than the sole trader or partnership, then you're sorted. That's an easy decision to make. Be a limited company, save your £5,000, pay an extra £1,000 or £2,000 in accountancy fees to keep all the compliance that you need to keep, and we're sorted. So nice, easy planning up to last month. So what's changed? There are some changes afoot, and one of the changes is that there is this new introduction of 7% surcharge on dividends over £5,000. So instead of paying 20% tax, you're going to be paid 27%. If you're paying 40, you're going to pay 47, and so on. Now, the reason I bring this up is because it affects the planning dramatically. If you're a £100,000 earner, and many of our clients are, and if you want to know, if you haven't got there yet, then you want to know how to get there, we can talk about that. That's another program. But if you are looking at £100,000, if you went through a limited company and that's the choice you had, if you haven't got a choice because you're already a limited company, this is not for you. There's a different program for you. But if you were thinking about a limited company for that reason, then what you're doing is what you're really saying is, I want to save this money, this national insurance, right? And what the revenue specifically tackled here is this idea of going from self-employed to limited company to save this national insurance. And what they've specifically said is they want to avoid that. They want to avoid that whole load of people, even though 10 years ago that was their main function, is to get people to go into limited companies. Now it's the main function to stop them, apparently. And so we want to compare the taxes in a limited company in total against the sole trader partnership route in total. And if you start comparing that, then you begin to see some really interesting changes developing now compared to where we were last month in the history of it. And it's a bit like fool's gold. You go to the limited company thinking you're going to save money, and actually you're going to lose money. And how that comes about is that you pay tax on the extra 7% on £100,000, and just to keep the number simple, let's say it's £7,000 extra because of this 7%, and you save the £5,000. Let's say it is 5. It's not quite there, but you save £5,000 on national insurance as a self-employed person. And now what it's doing is it's cost you an extra £2,000 to be a limited company and get dividends. Now, I'm just giving this top level figures. There's a whole load of planning and issues that you want to be involved with and thinking about, but please just don't go for this old rhetoric that doesn't exist anymore, that limited companies will save you tax necessarily, because they don't necessarily save you tax. It's a whole dynamic. It depends whether you earn £30,000, £50,000, £150,000, £500,000 or £1 million. These are the factors that can change and affect the decision. And unless you really compare and contrast, you could easily make a foolish decision and end up paying the price for many, many years to come. So what's on the menu then? What have we got to choose from? You've got a few choices here, and the first one is a limited company. You've of course got the limited liability partnership. Now these are the top two I prefer to the exclusion of the others, because you want to limit your liability. Please, if you hear anything on this session, please hear that we want to limit your liability and not put all your assets up for grabs. You want limited liability, limited company, limited liability partnership. Alternatively, you could be a partnership or you could be a sole trader. I don't like those two because they come with unlimited liability. Please avoid those like the plague if you at all can. Dangerous and to be avoided if you're serious about running a big business. Now, of course, if you're running a bog standard business and get full insurance, well, you and I both know insurance companies sometimes look to weasel their way out of paying out, but it's up to you to decide how well you want to protect your personal assets. There are many stories, and unfortunately I've heard too many of my clients getting caught out by having the wrong advice in the past, and they've been caught out. But so hold fire though, right? Remember, this is not the time to go and jump and take action. This is the time to think, plan, because this is not passed in the budget yet. This hasn't passed into law. So please don't go in and charge in and go, right, I need to do this or that, because we're not in law yet, and so you need to hedge your bets. Now the chances are something like what I've discussed is going into law, but I don't know exactly what it might be, and so as a result, you want to just make sure you err on the side of caution and think about it, get some good advice, and maybe wait a few weeks now before the budget comes up. So how do you plan? One of the things we're going to need to make the plan is know what your numbers are. If you don't know your numbers, then you really need to, and one way of doing that is through online accounts. If you want to talk to us about Xero or look on our site, we will put a link on the bottom of this video to that page, and you can have a test drive of this amazing software, which we love and help clients, with a hands-free, hassle-free bookkeeping service and stuff. Reduces hassle and lets you run your business really well with the metrics that you want to be able to manage on the tip of your fingers. Tax planning is key then, and so by all means, you ask your financial advisor, ask your accountant for advice on this. If we are your accountant, of course, you can ask us, and we can agree how we might arrange a projection for you and do some analysis for you to get the figures. If you're not a client, then let's see if there is a fit for the way we think, for the way we work, and if there is, we'll talk to you further about how we may be able to help you with tax planning. We have other resources available on the site. We have methodology to increase profits called our Profit Multiplier Program, which includes our Identify, Quantify, Multiply program, which helps you take your business from where it is and double its profits, within a time period. So, 2-3 years, and then double it again, 2-3 years. Obviously, the bigger the profits are, it's obviously harder to double, but we look to make the business easier to run, more valuable, more profitable, better cash flow. And next steps, really think about where you're going, think about what choices you've got, get some advice. If you want a plan, talk to us about a plan. Listen to this video again, understand that the choice between limited and non-limited is now more dangerous than it ever was, more interesting than it ever was, and has more potential for saving or losing money than there ever has been for as many years as I can remember. So get some advice, maybe click on our 10-minute quick chat if you want to just find out what we're about if you don't know us, and see if there's a fit. This is all I want to just cover today, and hopefully it's been of value to you to cover a few bits and pieces to alert you to the dangers of dividends now. The thinking of dividends is now old hat. We need to be aware of that. The telephone number to contact us is on screen. Our website is on screen. I look forward to speaking to you soon. Until we do, and it's a small world and a short time frame, take care of yourself and take care of business. All the best, and goodbye.